We as angels and also as venture capitalists look at things as oxygen, aspirin, or jewelry. Will your product become oxygen to your client? i.e., they can't live without your product. That's the sort of thing I want to provide money to, something where the client views your product as oxygen. If it's aspirin, aspirin means that it's a very nice product to have when you have a headache, but the market needs to be very large because most of the time we don't have headaches, but somebody somewhere in the world does. So aspirin is a needed product, but only from time to time. And jewelry is a not needed product, and you only buy it when you're feeling really rich.
Hello, everyone, and welcome to this new episode of the Fundraising Insiders podcast. We are probably around we're getting close to episode 20. I don't really know about the order sequence yet, but I can say that this is the 18th one that I'm recording. So, Adam, I'm very happy to have you on today. Today, we are going to tackle angel investment, mainly, amongst other topics. And I have you nice and fresh because you come back from an amazing trip. We were talking about it just before starting the recording. You were in South Korea to work on seaweed. So Adam is someone that I know from my time as an entrepreneur in the ocean ecosystem, and he was kind enough to accept to share some of his learnings and his wisdom of many years of investing in different financial vehicles, let's call it. And right now, what you do, you describe, and we'll get back to it. You describe that what you do is 80% of advising and operational support to companies, and 20% is actually the investing activity that you're doing as an angel and through other networks like SeaAhead. So, Adam, please tell us more about who you are, how you came to do what you're doing today, kind of your life path, and in a brief introduction, please.
Thank you very much. Yes, I'm Adam de Sola Pool, talking to you today from Cambridge, Massachusetts, which is my current home. I did most of my work in Europe. I was a venture capitalist and a company doctor, and in my venture capital work, I built a lot of wind parks and solar parks, and eventually that company that I helped found and was the first CEO of Continental Wind Partners became the largest Central European wind developer, and it expanded eventually to Australia. And finally, some of our partners sold it for 2 billion euros. And so it was a great success. And that allowed me to retire at age 55 to Cambridge, Massachusetts, where I am now. And I got deeply involved in ocean tech investing because I like pioneer investing. Angel investors have to work together because we are investing our own money and we need to cooperate with experts in the field. So I could be considered an expert in wind technology investing, but when I got into ocean tech, I needed to reach out to the other people who are involved in it and learn from them. And so that's why I was just on this trip to South Korea. There were 23 of us who were all different forms of angel or philanthropic investors. And we were all going there to see what the best practices in seaweed investing are in Korea. And we went to one bay in Korea, and our host said, now, if you look out over all the seaweed farming that's going on here, this one bay is as much production as all of the EU and North America combined. And there are over 100 such bays in Korea.
I think you're putting the finger on something that might not please some people in EU, because I know there's a lot being done in EU seaweed. That's, of course, where I come from. And a lot of talk, but when you look at the volumes, EU is ridiculous in terms of volume, but is leading the way in terms of regulation. That tends to be a recurring joke with EU. But it's good because there's also good practices are being put in place, a lot of work being done to look into mechanization. But Asia is good because it's where it was all born. The source of seaweed and the major plants that are cultivated come from Asia. And so going back to the original wisdom is always a good thing. Now, this podcast is theme agnostic, although, of course, from my personal network, I love to receive people who come from the ocean. But we'll talk about many other things. And I think today, the key thing is how to do angel investment and the evolution from the VC world, where you started your career, and going to angel investment. What are the main differences? In our first, not our first call, but in the discussion we had preceding this interview, you mentioned to me that you had 20 or so angel investments that were done, looking to get exits out of it. And through this journey of investing, you actually adapted your technique, your approach. You said that you have 3 different types of investment. There's the original 5 to K small tickets to see how the company goes and seeing how they use this capital. You tend to put a bit more. Then you have larger investments. So please maybe run us through your angel investment journey, how it started and the key learnings there. So maybe some people out there who are either looking for angel investment get to understand how angels think, but also maybe some fund partners who are looking to do some angel investment on the side. It's a very common thing, could take some of those learnings as well.
Well, every angel is somewhat different, but in my particular pathway coming from venture capital, I thought that maybe I could eliminate the bad companies from my analysis because I had a investment methodology from being a VC. And, most angel investments don't work out, but if you can eliminate the bottom 30% and you only focus on the top 70%, then the odds are much better stacked for you than if you are looking at all of it. That actually is how I started, but it didn't turn out to be an effective tool because there were so many different risks that I couldn't even begin to think about from very early stage investing that, in fact, none of my first investments have yet produced an exit. Some of them are still growing and some are doing okay, but I did not actually skew the odds in my favor sufficiently. So then I switched my methodology to what we call spray and pray, which is what you just mentioned earlier, which is I put in a very small check, $5,000, $10,000, into almost any company that has a logical business plan that is, for me, ocean related. Other people do it for entertainment or other people do it for other types of industries. But I do spray and pray. And that puts a small check in. And then over the next 6 months, 12 months, 18 months, you watch how the managers manage the company. And if they're doing a good job, you write a bigger check, a $50,000 check or a $100,000 check, and you help propel the company along. Well, that methodology also didn't work out to produce any quicker exits. I think it gave me a much better sense of the company management teams where, in the cases where I do put larger checks in later on. And also, I had many more quick failures because I wasn't actually doing diligence on any of these. It was a spray and pray methodology.
Gotcha.
So given that I have allocated my entire budget to angel investments, those 20 that I talked about, and I don't yet have an exit, I'm now only putting money into my follow-ons in my companies that are succeeding. I'm not doing new investments. However, I am taking even smaller checks than the $10,000 checks and considering it philanthropy. So I will go into crowdfunding. I will go into a bunch of different small check size opportunities. And some of these crowdfundings actually produce millions of dollars going into companies. There's a very good platform in Portugal called Go Parity that has Portugal, Spain, and Canada. And they're able to raise hundreds of thousands, if not millions, from a crowdfunding methodology. So I don't say that I'm not investing entirely, but I am taking a philanthropic approach to it now versus expecting a return approach.
You were mentioning earlier that part of your trip in Korea was with angels and also with philanthropy. Now, especially for early stage companies and when it's hard to either justify high revenues, high returns, or you don't have revenues coming in for a couple of years, the VC funding is not the only route to take. If anything, it's also a trap in itself. And we'll talk about those commitments a bit later. But when it comes to angel investing and even more dedicated, it's called philanthropy. What are the ways philanthropists usually invest? Is it just based on the heart? Is there still some kind of due diligence for the impact it has? Because philanthropy, if we take the etymology, you have the philos, you love, and anthropos, humans, so loving humans means there needs to be an impact. So when you do your philanthropic investment, is your due diligence as small as it is, as you mentioned? Is it different from the way you do your angel investment? Is it because you look more into the human impact versus the financial impact, for example?
Yes, certainly I looked more into the human impact and whether the company will have positive environmental and social goals if it succeeds. And I'm not as concerned about whether it's going to reach its millions of dollars of sales. So I'm downplaying the financial impact. Of course, it needs to earn money to be sustainable. The companies can't go forward unless they have cash flow. But I'm not so concerned about that cash flow. I am more concerned about the social and environmental goals that the company has and whether they are achievable.
I see. So now we've talked a bit about angel investing. The method is a bit simpler and, of course, adapted to every sort of angels. When talking to other angels within your network or within syndicates that you're part of, do you feel like there is some patterns, some recurring things that is so different from an angel compared to a VC? And if there is such a pattern, what would you say this pattern is?
Well, some of the most successful angel groups are the large ones, because what makes a large angel group successful is that there is somebody in the group who really understands the industry and can help the other angels come to a quicker decision. A VC with hundreds of millions of dollars under management has enough of a budget to be able to afford hiring in a consultant. Angels with much smaller investable pools can't afford to hire in consultants, so they need to ask questions themselves. A small angel group or a group that has no expert will just generally waste an entrepreneur's time by asking lots and lots of questions until they hit upon the 10 or 12 that are the reasonable, influential decision-making questions. A big angel group often has that one person in it who can help the other members get to those 10 or 12 questions really quickly and thus make an effective decision.
Would you say it's a good thing then, or is it an advice you could give to companies when they're looking for angel investments, say in a syndicate, to immediately ask for, do you have an expert in my field? And if you do, could I get the warm introduction and maybe have a second call with not only the head of the group, or I don't really know how when you talk to an angel investment syndicate, do you talk directly to the experts in your industry, or is there a first screening? How does it happen? I suppose it varies through syndicates, but if I was I'm a founder and I work in a specific field, let's talk mining using seaweed.
Yes.
Is this something that I should do? Just ask directly to the group. Do you have someone who knows about phytomining, about seaweed adsorption, about metals? And maybe that's a good way of also sorting who are the right angel groups.
Exactly right. You are spot on. It is very important to do some research, both ahead of time and once you're in contact with the group, and say, who is your seaweed expert? Who is your Bitcoin expert? Who is your animal health expert? And then convince that person before you go in front of the whole group, because if that person is already going to be your champion, you will move through the group so much more quickly and efficiently. And that person really leads the group in terms of the decision-making process. So you can find this sort of thing out by looking. Some groups list all their members' names, and you can do a LinkedIn search. Other groups list all the companies they've invested in. And if you see one that is tangentially related to your field, find out who from the group has invested in that company, and then you can actually talk to somebody who has a sense of the industry already.
How do you know who from the group invested? In the UK, I would say you go on Company House, you look at the documents that were issued by the company, there's shareholder rights, the shareholder the agreement, then you can see who invested, and whoever doesn't seem to be a venture member, then will most likely be an angel, and then you reach out to that person. If that's not possible, how else do you find an angel? Because this is probably the number one question founders ask themselves or ask others. Angel investment sounds great. You have potentially active capital because you have experts that invest. They are maybe closer to you on the human level because they're investing their own money, so the commitment is different, but they're harder to find. If I want to find an ocean VC, I probably type blue wave capital or ocean bubble money, and they're all the same names. It's easy to find a VC. Angels are not easy to find. So what would be your advice on finding the right angels, finding the right groups, and accessing them? Is it just LinkedIn? Are there events you would advise? Are there specific behaviors to have to meet those angels?
Well, for the ocean, Thousand Ocean Startups and their annual events is a great place to attend. Most industries have an annual conference. The Angel Capital Association for the US, great place to go and find like-minded people, but also PitchBook and CB Insights and those sorts of platforms, which you can generally find your way into either with a free trial or by going to a business school. For example, if you go into the Harvard Business School library, you can get access to these platforms. Getting into the Harvard Business School library requires a little bit of nuance. If once you're in, you can get access, and then you can look up and see who's listed. And oftentimes some of the larger angels are listed. The same is true with Carta. The Carta lists are sometimes available. There's a whole bunch of research that can be done. It's hard, but I know that there are sources out there. And I've had people who reach out to me fairly frequently and say, "Hey, Adam, I saw you invested in X, and I'm doing something similar to X. And would you give me a phone call?" And those mostly come through LinkedIn, but they've done the research and see that I've said something about investing in a company.
Would you say from your personal experience and the other angels that you met in your career that angels are proactively getting out there, getting on those platforms, going to those events? Or are there also just more discreet angels, and how do you get to reach out to those? What does it tend to be?
There are always more discreet angels, but the ones who are actively investing in a sector are getting out there and participating because information, data is crucial to making good investments, whether it's impact investments or financial investments. You've got to know what's going on. And that's one of the things that I learned by going to South Korea. I learned a lot about the seaweed industry out there I didn't know beforehand. And so you have to be actively out there in the industry if you're going to make wise and impactful investments.
Let's talk very briefly about the advisory work now, because as you said, it's 80% of your time. And although it won't be 80% of the episode, it is important to address it. When you say that most of your time is advisory, be it with SeaAhead, with Macquarie, Sustainable Ocean Alliance, Hatch, you have all of these programs that you advise for. What is advisory? Advisory can mean 100 different things. When it comes to you, Adam, what is your way of doing advisory, and why do you do that specifically? What do you value so much in the work that you provide to those companies?
Well, I say that I will provide an hour of my time to any ocean tech company that reaches out to me. And that's part of my deal flow sourcing is if I'm really interested after that first hour, I'll say, "Hey, let's have another call and another call." And I will develop an rapport with the entrepreneur. And so when it comes time for that entrepreneur to raise some money, then I may well invest. But that's why you spend 80% of your time advising. As I used to say to my employees in the wind park development business, you have to kiss a lot of frogs to find a prince. And basically, what I'm doing by offering an hour to any ocean tech company is kissing a lot of frogs and seeing whether there's anything out there that gives me satisfaction, either from an impact sense or a financial sense, and then working, let's say, an hour a month with the entrepreneur to help them develop their business plan or their joint development agreement or the product or all the different things that they may have issues with at an early stage, so that you really have a better sense of the company when it comes time to raise money.
Now, I wanted to talk about this a bit later, but I think this makes for a great transition. So we'll slightly remodel the podcast structure. Kissing a lot of frogs requires loving frogs, which should be more up my alley as a Frenchman. Partially French. But the other thing is it requires a lot of time. You said it's 80% of your time. And when it comes to VCs, the frog kissing should be a full-time job, but it's not all they have to do. There's also the due diligence, there is the investing, there is following your portfolio, etc. It takes a lot of time. So let's talk about VC for a second. We mentioned VC could be a trap. It could be a frog trap, if anything. Why is VC a trap? Let's start with this, and then we'll go on to the part of the discussion of advisory and how VCs should play a role, because operational and VC tend to be quite separate, but I know we both share in common the fact that this is something that should evolve, and we'll talk about this just after. But for now, let's define. Why do you say that VC are a trap? The type of funding? Is it the requirements? The engagements related to it? Tell us more about it.
Well, VC funding generally is a 10-year fund that the VC has raised, and he or she is beholden to the people who've provided them funds. And so they've got basically roughly 3 years to invest the funds, 3 years to grow the company, and 3 to 4 years to exit the company, to turn the money around and get it back to the original investors. That is imposing a pretty tight set of constraints on an early stage company, particularly that is ocean hardware tech, where it takes a lot of iterations and a lot of ocean sea trial testing to prove a good product. And so most of my investments are going to have 15 to 20-year time horizons before they are exitable. And so if a VC comes in and demands that you have an exit before the 10th year, you're going to be trying to achieve something that's not really achievable in the time that's required. So you're going to have to take some risky bets and basically try to grow your company so quickly that you're not building a good foundation for success in the long run. So the VC's time horizon and the VC's return expectations are a lot greater than ocean hardware companies can satisfy. There may well, may well be some ocean fintech companies, for example, ocean insurance, that can grow quickly enough to satisfy a VC time horizon and a VC return horizon. That's why it is a trap to bring a VC in. Let me just say also that it's very wise to bring in 2 or 3 VCs at the same time rather than focus on one, because one may well change its philosophy of investing. They may start out thinking that they want to be in aquaculture and then decide that, oh no, we're not going to be in aquaculture, we're going to be in software. And therefore, they aren't willing to provide you the support that is necessary as an entrepreneur over the whole 10 years. If you bring in 2 or 3 different VCs at the same time, it's most likely that the one who's changed their mind is substituted for by the 1 or 2 that haven't changed their mind.
Gotcha. What are other eventual considerations to take when taking money from a VC? Sorry, you mentioned the timeline of investment. So one thing that I used to try as a founder was asking the VCs where they were in the cycle, because if they're closer to the last years of investment, that means that the divesting cycle is already started and you're losing a couple of years. Is this something that you can ask directly to a VC, or would you suggest asking in a more indirect way or finding out in another way? Is this something they just answer like this most of the time?
Well, you certainly can ask that directly, because the VC will want you to know what sort of time horizon they're thinking about. And if they say our fund ends in 5 years, that's probably not a good fit for most ocean hardware companies.
Or hardware in general. I know we're keeping the ocean focus, but there's definitely this shift between hardware and software. You mentioned fintech, but any other software or SaaS platform will not have the same time to revenue. Now, the VC model has specific problems maybe, but it also has advantages. But if you were to say we go back in time and we create or we plant the seeds that would make VCs better, if you were to create a VC tomorrow, how would you make things differently? Would you, and I suppose a lot of things that you would bring would come from the angel investment mindset. So what would you add? And of course, let's try to do it realistically, because the big barrier of VCs is that they only have 2% of their fund that acts as a management fee. So it's not like they can tap in more resources. So what is it in their strategy that they could do different? As an angel, you put smaller tickets to study the companies and do a bit of that due diligence by learning from the inside. But a VC can't always do that. So how else would you improve this system, say with a focus on hardware? When it comes to hardware investment, how could this made how?
Well, there are two things I would do. One is I would change the 10-year model of VC funds to 20, 30, or as the AquaSpark Aquaculture Fund has done, made it an evergreen fund. And there are more evergreen funds getting established these days. And that means that they're not focused on getting an exit. They're focused on growing the company for as long as is needed until an exit is logical, because they don't have a specific time horizon. So if, 20 years or 30 years as a fund life would allow you to grow companies naturally. That's one of the two things. The other thing is I would marry a venture capital fund and a first-of-a-kind project fund so that you don't have any conflicts of interest between the venture investors and the project investors. The project investors will be owner-operators of the very first units of the technology, and that will prove that the technology works and get it certified by whatever standards bodies are out there, so that when the exit of the technology company comes, it is based on a proven operating, functioning technology versus one that just has a pilot and you're not sure whether it's actually going to work over the whole lifespan.
Can you explain a bit more what you mean by what is commonly called FOAK, first of a kind? What do you mean by a first of a kind fund, and how is that separate from the venture investor?
Well, let's just say you have a wave energy technology. It's capturing energy from waves.
Yeah.
If you invest in the technology, but you do not actually build several projects to show that this technology really works out in the ocean over numerous years, people will be very skeptical. Why should I buy something that's unproven? So having a FOAK fund attached to a technology fund where the partners are well aware of what the pluses and minuses are in the technology, that allows you to actually build the first few units, prove that it works, let's say, over a 5-year time horizon, and then you sell the technology company for a much higher premium than if you were just having a risky, proven technology. The first-of-a-kind project fund would actually own, operate, build the technology and make sure that it is actually a viable technology. And because it would be the same people operating both funds, you don't have the worry, if you are the buyer of the technology, that something's being hidden from you. You actually know that it works.
This is where it gets a bit technical. Who puts the money? When you mean the FOAK fund, is the FOAK fund financing just the pilot, where the venture fund is putting an extra bit of cash for, I don't know, the rest of the research and maybe some of the OPEX and the marketing? How are you splitting the money allocation, and are the LPs different for the venture and the FOAK? I'm struggling a little bit to hear this.
Okay. Let's just say you have a 300 million euro fund.
Yeah.
You would allocate 1/3 to the venture and 2/3 to the FOAK.
Gotcha.
And the 1/3 that goes into the ventures, some of them will fail, some of them won't work. But the ones that are actually showing great promise, the project side will allocate money to build the projects and prove it out. And it's the same LPs in both sides of the fund. But what gives the LPs the extra interest in this is that they know that the proven technologies will exit for maybe 10 times revenue versus the unproven technologies, which would only exit for 2 or 3 times revenue.
And so are you putting money at different times so that the venture money comes earlier and the FOAK money comes once you start to?
No, you put all 300 million, you raise all 300 million at the same time.
I mean, in the investment in the company. So when you invest in a company, is the venture fund investing in, say, pre-seed seed? And for those who reach Series A or pilot or project level, then the FOAK fund comes into play.
Correct. Exactly right.
So you're splitting your cash to buy different candies at a different time based on whether you think they taste well. Okay, very interesting. So it's the way you allocate the capital. I've actually recorded an episode last week with Adi of the Regenerate Asset Management, where they also have this multi-layer approach. Because they're an asset management firm, they have this more embedded in their DNA, but they have a VC fund for early stage and they have a PE fund where they also correlate the investments between the two. You could kind of see it as it's not exactly this, but it's a bit like CVCs are doing, at least strategic CVCs, where the investment is being done for what makes sense upstream. In the case of a PE or in a Regenerate, for example, they're not doing the investment just because they have something above, but it does influence the investments below. In the case of a FOAK fund, the first investment is justified by the fact that it can go into the FOAK and the FOAK justifies the bottom. And in a CVC, it's just the mother company justifies the first investment because it can go and serve up there. So that's very interesting, giving a proper storyline to your money. You're giving story to money. And the first one, so to come back on the first point you were saying, which is I would increase the life of a fund to 20, 30 years. The immediate gut reaction of any VC out there and probably LPs is, how about my IRR? My IRR is going to drop. If I wait for a company 20 years to exit, where do I find the LPs that are actually okay to put money for 20 years? They also want to have returns within 10 years. So how is it that you approach both the fundraising as a fund differently when you have 20 to 30 year as a vision? And how is it that you tackle your investment thesis? Because suddenly you're not looking at your 10-year revenue projection, but 20 and 20-year revenue projection. God knows what it means and if it's ever going to get there. So there's also a different way of how you approach investment, as in putting the money and getting the money.
Yes. Well, most pension plans are 20, 25, 30 years. So you are actually matching the pension liabilities better than you are with a 10-year fund. So if you went to, let's say, teachers' retirement programs or government employee retirement programs, this sort of longer-term investment should be part of the portfolio. It may not be the dominant part, but it should be part of it. You also would change your investment because you would follow along, as we were talking about with the FOAK fund or your asset manager. You would put in small amounts at the beginning, and for those companies that do grow, you'd put in more in the Series A and more in the Series B, C, D. You would just keep following along with the growth ones, and you wouldn't be investing more in the non-growth ones.
Mm-hmm. Okay, so you're tapping into a different pool of money, and the money trajectory is different. That's very interesting. Now, being conscious of both of our time, we always have our typical segments, the yes, no, and the this or that, which is very rapid-paced questions. So probably I'm going to ask you something around 10 or so questions in around 1 or 2 minutes. You either answer option A or option B, and later on we'll have the same with yes or no. And don't worry, some of those questions might seem intentionally Manichean, and you might think, oh, I want to say both. You can say both. However, I'll try to ask you to pick one or another, and then we'll have time to discuss it. And if you want to say, well, I said this, but there's a nuance to it, we'll talk about the nuance later. How does that sound?
Good.
Beautiful. All right. So let's go with the this or that first. VC or angel investment, which one do you prefer doing?
Personally, I prefer angel investing. It's much more fun.
And if you were a startup, would you rather take from VC or angel?
Definitely take angels who know my business versus angels who don't know my business.
Gotcha. Then, do you prefer doing 20 more small checks or 3 big ones?
3 big ones for the administration purposes only. However, I'd prefer to know the 20 people behind the checks.
Gotcha. Now, if you have to do only one thing and drop the other, would you rather remain an investor or a mentor?
Mentor.
Ocean tech or clean tech broadly?
Ocean tech.
As a company, would you rather take grant money or philanthropy?
Philanthropy. Probably. Hard to say.
We'll develop on this one after. What matters more, meeting with a person without a pitch deck or having a very strong and well-structured presentation?
Meeting the person. You should be finding out more about the person you're meeting than you should be telling them.
All right, I see. US ecosystem or European ecosystem, which one feels better, healthier at the moment?
European.
That one is very interesting. Is that for the startups or for the fundraising as well?
For the startups. There's a better safety net support structure in Europe. Checks are bigger in America.
Gotcha.
But if I wanted to run a company, I'd want to run it in Europe.
Lead the round or follow?
For me, follow.
And if you had the opportunity to lead, would you lead it?
Only if I absolutely knew the industry inside and out.
Gotcha. And finally, if you have the potential to do so, would you rather exit in 5 years or keep it and go in the long run?
Go in the long run.
All right. So that was the first part. We can take a breath. Questions are over till the next ones. And I want to come back on one other thing. So you mentioned mentor or investor. This one was very quick. You immediately said mentor. Why? Why would you remain a mentor and drop out the investor bit?
One, the mentoring is my deal flow screening. If I stopped being a mentor and just was an investor, I wouldn't have any knowledge of the industry. How do I get information about the broader ecosystem to know if I'm not doing my mentoring?
Gotcha. And then we had grants and philanthropy, and they said this one was a tough one. So let's go into it. You had an answer, but it came with not the same speed as, for example, when I said ocean tech or clean tech, you said ocean tech or the mentor or investor. How come? What is the difference between grant money, philanthropy? When would you advise a company to look or to seek for more philanthropy versus seeking for grants? And when to take which one for what is the type of projects? Does it differ because of your status, your stage, et cetera, et cetera?
Well, I had to think about how I define grant and philanthropy.
Okay.
And in my own mind, I defined grants as mostly things like the US SBIR grants or the NSF grants. They tend to be larger and more sort of periodic and don't come with a lot of mentoring. You apply and you get the money and you do something with it. And I think of philanthropy as coming from an individual. And therefore, when I was trying to decide which was better, I was weighing whether it was the relationship with the human being. And that is so important because people who are giving this philanthropy probably are very interested in your company. They're not going out there and just throwing philanthropy to the wind. For example, I don't do ag tech philanthropy. I don't know anything about it. It's not my interest. Ocean tech is my interest. So you are getting a person in the philanthropy who's interested in your business and who can help your business, probably. That's why I came down on the side of philanthropy versus grants, which are generally larger but don't come with the human contact.
I'm going to be devil's advocate because I love doing so, and I think that the best conversations come from having a devil in the room a little bit, and I'll be the devil. What do you do of the potential, so 2 risks, the potential that philanthropy might crowd your cap table, first of all, and secondly, that you might end up with philanthropic fund that ends up being more of a burden if the person is not a professional and end up worrying too much about what you do and just constantly being there and maybe clouding your judgment or taking too much of your time.
Yep. Big risks, but in the ocean tech space, for example, the Schmidt Ocean teams, they're really smart and professional, and they provide philanthropy because they are industry specific. They really know what they're doing. And so I think it's on the entrepreneur to weed out and avoid the person who is going to be a drain on the company.
So that's your own due diligence side. As a founder, you have to do diligence on whoever you bring on board.
Correct. And I do not believe that a smart philanthropist would ever crowd your cap table.
Gotcha.
So, there are philanthropists out there who do revenue notes and things like that. Mm-hmm. Those are really smart ways for companies to build themselves, and the equity investors will appreciate that versus taking some form of equity that would crowd the cap table.
It's actually one of the questions I forgot to ask. I'm just reading it now. My second question was supposed to be revenue notes or equity. Can you explain very briefly the principle of a revenue note versus equity for our audience out there?
Well, a revenue note, or they have a forgivable note as well. These are like equity, but they're not taking equity returns. They're taking a percentage of revenue that comes into the company at some later stage. And
Right.
So if you get a revenue note, when you, let's say, have a bench example of your technology, you won't have to pay a penny on it until you actually start selling something and money is coming into the company. So if
Right.
you have, 5% of revenue, that's almost nothing for a long time. And then once you start selling, you're giving 5% away to the person who provided that early stage capital. You also could have forgivable notes, which are notes where if the company does not perform, i.e. goes bankrupt, it's forgiven. Whereas if the company does well and gets sold for hundreds of millions of dollars, you share some of that return to the provider of the capital.
As a first-time founder, we had someone who proposed something along those lines, but we thought the numbers were just completely exaggerated. Actually, they were exaggerated. Having talked with people who had the experience, what would be your advice to founders to evaluate those kind of deals? When I come with a revenue note, here you mentioned 5% of revenue. How do I know whether 5% is too much? Is it 5% up to a certain amount of revenue? How do you judge what's good and what's not for this kind of deals? Equity tends to be easier because you can sort of compare to other valuations and to what's out there. For the revenue notes, it's a bit more complicated. So how would you advise going about this?
Well, I would advise finding a mentor who's done this sort of thing before and who can help you know whether it's crazy or not. And it's always up to what your options are. If nobody's going to provide you equity and somebody's going to provide you a revenue note, even if the terms sound onerous, it's your only money. So the best money is organic growth, is selling a product. Somebody wants your product and is willing to pay you a premium to get your product. We as angels and also as venture capitalists look at things as oxygen, aspirin, or jewelry. Will your product become oxygen to your client? i.e., they can't live without your product. That's the sort of thing I want to provide money to. Something where the client views your product as oxygen. If it's aspirin, aspirin means that it's a very nice product to have when you have a headache, but the market needs to be very large because most of the time we don't have headaches, but somebody somewhere in the world does. So aspirin is a needed product, but only from time to time. And jewelry is a not needed product, and you only buy it when you're feeling really rich. So we're trying to, as an investor, we're trying to figure out whether you are oxygen, aspirin, or jewelry to your client.
Gotcha. All right, that's a very interesting comparison. We had another comparison. It was whether it was a pill or, I can't remember. I'll find it again. It was Vivek Dogra from the Defossilization Development Fund who was saying the same thing, where you have to consider what is your product, whether it's a solution or whether it's something that eases the pain. So whether it was a pill or an ointment, basically. And this comparison is a little bit what you said, and it depends on what you're doing. Of course, it affects the investment. Now, being conscious of your time again, we have the next part, which is a yes or no. It should be a bit more straightforward because some of these have actually been answered before, but it will be nice to summarize all of them in one format. So let's go for this. It should be fairly straightforward. Are you ready for it?
Ready.
Let's go. Have you ever told a founder that their company was not fundable?
Yes.
Do you think most ocean tech startups have any business seeking VC money?
No.
Have you ever made an investment you knew was risky and did it anyway?
Yes.
Do you actually read every deck or presentation that you receive?
No.
Do you think the LP base of most clean tech and ocean tech VC funds is the structural problem? Is it on
Say
the...
that.
So,
Say that.
do you think the structural problem of clean tech, VC, and impact funds is the LP base?
No, I think it's the ecosystem metrics.
Right. Have you ever changed a no to a yes after a second conversation?
Probably yes, but can't remember it.
Okay. Would you ever write a check based purely on the founder, ignoring completely the business model?
Yes.
Angel investing, the way you practice it today, would you consider it closer to philanthropy or finance?
Philanthropy.
Have you ever regretted not investing in a company that you passed on?
Yes.
Is fundraising fair for hardware and ocean tech founders?
No.
Would you do it all over again?
Of course, yes.
And finally, are you having a good time on the show?
You bet. Yep.
Amazing. There's one of these questions that I'd like to come back on, which is the LP being not the actual structural problem behind the VC ecosystem, but you said it was the entire ecosystem, and you mentioned some metrics. Can you develop a little bit of this answer?
VC funds have to compare themselves to industry standards, and these are the metrics. If you are off of the metrics, you have a very hard time raising money as a VC.
Right.
And this is why you end up with 10-year funds, because most people previously had 10-year funds. And you want to be able to go out to the LPs and say, you're a top quartile or a top decile or a top 1% fund.
Mm-hmm.
And so you're constantly having to look at how you compare to the others in the ecosystem in order to attract money. And that's because the ecosystem is organized around certain concepts. Are you an impact fund or a financial fund? Are you a software fund or a hardware fund? Are you an AI-focused fund or an ocean fund? It doesn't allow for deviation from the norm for the most part. If you deviate from the norm, you have to spend hours explaining how you deviate, and people will not have a basket of money to put into you.
So when you say the structural problem is the metrics, is what you mean is the norm that you compare yourself to is that problem. So the way to change that is what? To create your own norm and to create a new category?
Create new categories. For example, in ocean tech, there isn't an ocean tech category. There is not a blue tech category. I would go to the governors of every American ocean-facing state and ask them to report what ocean investments they have done in their state-sponsored pension funds. This isn't even requiring them to do it, just to report what percentage of the fund was invested this year in ocean tech. And slowly but surely, that would get people to pay attention to it. But because there is no metric, no benchmark for ocean tech investing yet, nobody does it.
Interesting. And I guess this model is also applicable to any other industries where norm doesn't necessarily exist or where the VC model doesn't apply. Well, let's look at the other investments, for example, pension funds, but there's probably other sources of funding, or you can look into hedge funds or banks or stuff like this, or corporate investments for all I care as well. Right.
Yes.
Now,
so one of the pieces of advice I give to ocean tech companies is to make themselves sound very much like a terrestrial company. So if you're in aquaculture, I say, don't talk about blue tech, talk about feeding people, because that's something that people know. People understand agriculture. They don't understand aquaculture.
Right. So always trying to make it relevant to your audience, understanding who you're talking to. Adam, thank you so much for all these learnings. I feel like there's so many times where I clicked on my little, I have this button that allows me to say, hey, this is where there was something important that was mentioned. I'm going to have to make a clip about this. And I pressed it a lot in today's episode. So I'm really, really glad about this. We got to discuss pretty much everything that we had either agreed to discuss in our call just before the recording, or other things that I had put in there, other bullet points as well. So really, thank you for everything. Now, as a close-up note, I always like to make the podcast a way for guests to have their own voice, to either ask for something or talk about something cool that you're doing. You told us about your trip to Korea. Now tell us more. Are you looking to invest in specific companies at the moment? You said you have some of your companies are growing, so maybe they are looking for funding or they're looking for specific partners to grow. Tell us, is there anything that we can help you with or that our audience can help you with?
Well, always get more involved in ocean tech. I think one of my most interesting companies these days is called Inversa, and it harvests invasive species and turns them into leather, which famous fashion houses use that leather. So it started out harvesting lionfish in the Caribbean, and now it has moved on to Asian carp in the Mississippi and pythons in Florida. A great job. And it has an interesting business model, which is that the baseline comes from the contracts from the governments, like the state of Florida, to harvest the pythons. But the upside comes from actually having a leather that is a beautiful leather based on a unique sort of species that is sustainable because it is harvesting invasive species and selling it to the famous French couturier houses.
I'm on their website right now, and so everyone should check those out. It's a really interesting model. I don't know if I've met someone who did something like this. I don't know if it was someone from the Inversa team or if it's someone doing something similar, but it does definitely ring a bell. I'll look in my network. Coming from the field of materials, I've been involved with a couple of companies that were looking into alternate materials or at least alternate sources of materials. So definitely that's an interesting one. So if you're looking for fancy material that are sustainably and ethically sourced, look up at Inversa. And I don't know whether they're raising funding anytime soon, if they're looking for any partners. If you're interested in this field, please give them a look or get in touch with Adam, who will put you in touch as well. I think those are the closing remarks. Any last word to say? Any last advice, piece of wisdom?
No, thank you very much. It was a pleasure.
Beautiful. Thank you so much, Adam. And to our audience, this podcast, if you're listening on Spotify, you want to have our beautiful faces, it will also be on YouTube. We are also going to publish a bunch of clips and reels and videos to make this information more digestible. I was mentioning the clips earlier. And also all of the learnings will be available on our LinkedIn. We always make posts about the guest, of course, but also the learnings. The idea here is to share the wisdom of our network with you guys. So thank you so much for following. We'll see you in the next one. And once again, Adam, thank you so much for having joined us today.
Bye-bye.
Cheers. Bye-bye. All right.